All right, let's just jump right into it. Welcome to this explainer where we are going to completely shatter some classic illusions of macroeconomics. If you have ever taken an Econ 101 class, you were probably taught a very clean, very predictable story about how money is created. But today, we're going to look at the actual data and see how money is truly created in our high-speed digital world. It's a massive shift from a dusty textbook theory of reserve ratios to the pretty startling reality of modern balance sheet speed. Let's kick things off with a fascinating question that breaks the most famous, universally taught concept in basic economics. Think back to that textbook money multiplier. A central bank creates money, commercial banks hold a fraction of it as reserves, and they lend out the rest. So what actually happens to that entire system and the math behind it when the required reserve fraction drops to absolute zero? Do we just get infinite money? Let's find out. Here is our roadmap for today. We'll start with the broken textbook model, look at how banks actually create money, dive into the real constraint stack, uncover the 6 new digital multipliers running our economy, analyze a couple of high-speed case studies, and finally ask the big question, is credit completely out of our control? Part 1, the broken textbook model. For decades, we were all taught a clean, predictable formula for credit expansion. But here is a surprising fact that completely upends that old model. Since March 26, 2020, the U.S. reserve requirement on net transaction accounts has been exactly 0%. Yep, the Federal Reserve completely eliminated reserve requirements for all U.S. depository institutions. Look at the basic math here. The old multiplier formula is simply 1 divided by the reserve requirement. Well, if you plug 0 into that classic formula, it breaks completely. 1 divided by 0 is mathematically undefined. This proves that reserve scarcity is absolutely no longer the bottleneck holding back credit. The central bank just doesn't control broad money by forcing banks to compete for a tiny supply of reserves anymore. Which brings us to part 2, how banks actually create money. So if required reserves aren't the limiting factor anymore, how does bank money actually enter the economy? Listen, we have to completely shift our mindset here. The old system asked a quantity question, right? Like, how many deposits can be multiplied from a set amount of reserves? But the modern system, it asks a speed question. How fast can balance sheet claims be supported? We are multiplying credit decisions into balance sheet claims at digital speed. The modern reality literally reverses the old sequence. Banks aren't just sitting around waiting for deposits to arrive so they can lend them out. No way. Step 1, banks make a loan the second they spot a profitable opportunity. Step 2, boom, that loan instantly creates a deposit on their balance sheet. And only then, in step 3, does the bank scramble to manage its reserves, its funding, and its liquidity. They act first and manage the consequences second. Let's look at part 3, the real constraint stack. Now, just because the reserve requirement is 0 absolutely does not mean that banks can just print unlimited consequence-free money. That'd be crazy. Instead of relying on one magic reserve ratio, modern credit creation is held back by what we call a real constraint stack. So a bank actually has to ask, do we have enough capital to satisfy regulators? Can we survive a sudden deposit outflow? Can we fund this loan at a profitable spread? Do we have enough reliable collateral? And maybe most importantly, will our depositors and investors actually maintain confidence in us? This entire stack dictates if a bank's balance sheet can actually survive carrying that new loan. Part 4, 6 new digital multipliers. As finance has digitized over the years, we've developed an incredibly interconnected web of new multipliers that dictate the blistering speed of this entire system. Let's fire through these 6 accelerators that have stepped in to replace the outdated textbook model. We've got data, collateral, funding, platforms, securitization, and confidence. You can think of each one of these as a giant accelerator pedal for modern credit. First up, data and collateral. The data multiplier uses open banking and API data to automate underwriting almost instantly. A digital lender can verify your income and approve a loan in literally seconds. Meanwhile, the collateral multiplier aggressively expands credit capacity when asset prices are rising. When your assets are worth more, you can borrow more against them via repo and margin markets, essentially using your existing wealth to unlock instant new cash, which expands the system incredibly fast. Watch how this really builds with the platform multiplier. Just look at this massive number. Over $5.1 trillion in U.S. consumer credit outstanding as of February 2026. Trillion. This multiplier shows how e-commerce embedded finance distributes credit instantly. Think of those buy now, pay later buttons you see online. The friction between wanting something and borrowing for it is totally gone, making credit creation incredibly immediate, exactly at the point of sale. Finally, we have the securitization multiplier, which clears balance sheets by turning those loans into tradable securities and selling the risk off to investors. But, and this is critical, the whole shebang relies on the confidence multiplier. Digital systems accelerate belief. If people trust the system, money flows instantly. If they panic, it drains just as fast. Confidence is the ultimate digital accelerator of both absolute belief and absolute panic.
Part 5. SVB, Stablecoins, and Speed.
So what is the terrifying reality when those digital constraints suddenly bind and confidence just vanishes? The collapse of Silicon Valley Bank in 2023 is the perfect case study. See, SVB wasn't about banks multiplying reserves too aggressively. It was all about digital speed. They lost over $40 billion in a single day and expected over $100 billion more to leave the very next day. That lethal combination of social media panic and mobile banking compressed a traditional bank run, which used to take weeks of people standing in line, down to a matter of hours. And we see a very similar, if not even faster, risk profile in the stablecoin market. By April 2026, stablecoins hit a massive $317 billion market cap. These are tokenized claims that can move 24/7 across digital wallets globally. They don't have banking business hours. A loss of confidence here creates run dynamics that operate completely outside of standard regulatory windows, turning a solvency concern into a liquidity crisis instantly. Which leads to our final section, Part 6, is credit out of control? With the system capable of scaling and collapsing at this blistering 24/7 internet pace, we really have to ask a hard question about our financial stability. Is it out of control? The honest answer is that credit isn't mechanically infinite, but its visibility is increasingly slipping away from us. It's moving into shadow banking areas like private credit funds. There is an estimated $14 trillion in offshore dollar credit outside the US that simple reserve requirements can't even touch. And systems like instant payments accelerate deposit flight, meaning credit is expanding and contracting way faster than our traditional data can even track. And this really hits the nail on the head. As the source analysis points out, the real issue isn't that the system is bigger than authorities can understand, it's that it can move faster than authorities can react. Digital speed itself hasn't just changed the rules, it has become the ultimate macroeconomic variable. Those old textbooks told us to watch the size of the multiplier. But today, the danger isn't the size, it's the speed. We aren't managing ledgers anymore, we are managing a volatile, high-speed network. So I'll leave you with this crucial thought to consider. How can policymakers and regulators ever hope to design safety brakes for a financial system that operates continuously at the speed of the internet? Thanks for joining me on this explainer, and hey, keep questioning those textbooks.